But let's connect with Shashank Khare, Senior Vice President with Kotak AMC. He presents the Portfolio Management Service for Kotak AMC. Shashank, good morning. Good to have you back on ET Now. What do you make of this week's price action?
I think there's been, sort of euphoria around the year end and the relief on fiscal cliff. So you've actually seen, a lot of these small mid-cap stocks, catching up in the last 10 days. My sense is that, this euphoria may die down in the next few days, and we may start looking at how the earnings season really shapes up. So I think, the year-end euphoria, don't get carried away by that, because I think the markets may take a pause and slowly, go as per how the companies report earnings and how they state their outlooks. I think that's going to be far more important. And again, if you're looking at where we are, this has been the longest up move since March 2009. In fact, in the last 3 years, if one were to look at, most of the up moves were lasting between 2 to 3 months, and it was followed by a sharp correction. I think this is the first time where we've seen 7 months of an up move sustaining, and and this has been the longest. June 2010 to October 2010 was another good patch where you had 4 to 5 months of an up move. I think longer the up move, better it is, because investors get a chance to understand the markets and at least participate at some point in time. Otherwise, in those 3 to 4 months of sharp up moves and sharp corrections, I'm not sure whether investors really got a chance to invest at all. And more importantly, higher the longevity, in fact, the primary markets actually begin to revive. So that's where most of the domestic investors tend to participate. So I think this market seems to be good from a longevity perspective. In fact, it's given chance for domestic investors who sold in, say, September or October to get back into the markets through the primary market route at least. So secondary market, I'm not sure how many retail investors or domestic investors would like to participate right away. But I think the primary market may give them a when to really start investing in equities at least. And last few IPOs or FPOs have led to positive gains for investors. So that is quite encouraging.
Just to Shashank, because Bharti Infratel, it hardly made any money for retail investors. So 2 IPOs, and you were claiming that the world has changed?
No, I think 2 IPOs, FPOs, one of the FPO did pretty well. Care and I think PCJ Jewelers was oversubscribed substantially, showing you that there is appetite for IPOs. After a long time, people invested in government stocks, because last 12 to 18 months, PSU stocks were shunned substantially. Given the way the government was, people didn't want to invest in government-owned companies as well. So after a long time, you've seen a change in mindset of investors, even willing to invest in stocks like NMDC. So I think that's a mindset change which one is really seeing in the last 2 to 3 months. It's not a question of how much money did they make, but it's a question of whether people are willing to invest in these companies at all. I think that was a big change.
Shashank, at the current juncture, do you think there is a lot of hope trade which is building up? Hope that earnings will bottom out? Hope that Reserve Bank of India will oblige? Hope that government action will only pick up some momentum?
No, clearly, I think last 1 to 1.5 months, that is getting built into the markets right now. I think interest rate cut was, built into in December as well. And that's the reason why you saw real estate stocks rallying hard in the month of December. I think the same, thing happened in PSU banks as well. Of course, the 10-year bond yield, went below 8% after a long time. But you also saw hopes getting built that RBI will cut rates. So I think a large portion of this discounting of cutting of interest rate is already preempted by the markets. So be it PSU banks or be it real estate, these have really rallied hard. I think the only segment which hasn't rallied is the the over-leveraged pockets in the markets, especially in the infrastructure space. I think that's the space where you haven't really seen any sort of traction. But I think the RBI cut is largely in the price in a number of cases.
Shashank, so of late, a lot of smart money is revisiting cyclical stocks. Do you think good quality cyclical stocks will have enough earning visibility and they could surprise you with earnings momentum, or as of now, it's again the hope trade which is driving these cyclicals?
No, I think see the valuation gap between the defensives as well as the cyclicals is large enough. I think the rally in PSU banks also was similar. If one way to look at because PSU banks versus private sector banks, the valuation gap widened significantly. Hence this rally materialized. Nothing really has changed on the ground. I think the same thing applies here as well. Cyclicals versus defensives. I think the valuation gap is huge today. So there's a good case that if few of the cyclicals start reporting better sequential numbers, you may actually start seeing these stocks sustaining and moving up slowly and steadily. So there's a good case to invest selectively in certain cyclicals. At the same time, I think markets will have a sort of a tendency to extrapolate across the sectors, across various cyclical sort of businesses, and start looking at an uptrend. And any interest rate cut could be actually materially positive for certain cyclical companies. So you may see that rally materializing in the next few months.
Shashank, what are your thoughts on commodities? Because of late commodity stocks, at least the large ones, Sterlite, Tata Steel, Hindalco, large commodity stocks have appreciated by a good solid 10 to 15% from the recent lows.
I think commodity stocks are again moving in line with the trend in the underlying commodities, be it ferrous or non-ferrous metals. And most importantly, I think the trade is clearly coming to life because of the way China is positioned. There is a clear hope that the Chinese markets will revive and the demand will pick up for metals. You've actually seen this beginning to sort of get positioned from maybe in the last fortnight of December, and you actually started to see steel prices actually move up. So I think the commodity stocks are moving in line with the Chinese markets. It's more to do with China and less to do with India and India's demand. So I think, and again, the fiscal cliff related relief which happened, led to a burst in sort of, upburst in sort of commodities itself. So I think that's the reason why the trade is really playing out.
Shashank, at Kotak, what's your expectation in terms of what the RBI may do this policy?
I think there's a good chance that they may go ahead and cut the rate which is long impending, and this could be to revive some sort of growth within the economy. Actually it's been long expected that there will be some sort of cut to stimulate the economy. I think that is something which is expected this time around. I think that's the most sought after sort of an event. Because while there are a lot of noises being made that the economy will accelerate from here and Indian economy seems to have bottomed out, I think most important point here is how the Rabi season also pans out. Because if the Rabi season actually positively surprises, you may actually see inflation, agri-related inflation, at least getting a backseat, and that could be a good platform for RBI to continue with rate cuts. See, I think CY13, the most important point here is the pace at which the rates are going to be cut. I think there is a consensus getting built that interest rates have peaked out. The question here is the extent of interest rate cut. Is it going to be 50 to 75 basis points, or is it going to be much higher? And what is getting built into the markets, and most importantly, the rate at which the changes could happen. If you're looking at a rate cut now and maybe 6 months later, and in the second half most of the rate cuts happening, it may be still be sluggish for the capex cycle per se, and the capex cycle may not revive as early. And I think CY13 will be most important to watch out as a year whether the capex cycle finally has been revived. So I think that's the crucial point to really look at, and capital formation is what the RBI is after. Look at the way they're talking about gold and gold related obsession amongst consumers. Clearly I think it's a question of money is going into productive assets, and clearly they are concerned about capital formation and capex cycle reviving per se. So I think a rate cut is definitely a very strong possibility this time around.
Shashank, do you think the high flyers for 2012 could get grounded this year? Some pharma names, select consumer names, and a couple of NBFCs?
No, I think, in consumer as well as in healthcare, they've been substantial outperformers, and the breadth was large. My sense is in CY13 the number of stocks which will outperform from these two sectors will reduce drastically. So the breadth within this sector will come down. To get large absolute returns from these sectors and in stocks across the board, I think it's going to be very difficult. There'll be select pockets in these sectors which may still continue to do well, but not very sure in terms of absolute returns whether they're going to be substantial, because I think in the last half of last calendar year the markets have discounted a substantial amount of positive news in be it consumer or for that matter pharmaceuticals, in certain consumer names, irrespective of how the growth was panning out quarter after quarter. People have gone ahead and discounted them. So I think it looks very clear that at some point the pendulum will swing towards the capex or the economy related stocks, and people may start betting on the other side of the economy. So while consumption will continue to chug along quite well, there's a good chance that at best a number of these stocks may be flat for the year. I think that's going to be a good optimistic scenario, and you may see at some point pendulum swinging towards capex, or for that matter even the most moribund infrastructure sort of sector, where monies may start finally flowing into these sectors, and that will be also linked to how the interest rates get cut. So that's how the possible allocation may shift, and it's been now years of underperformance for these sectors. So capital goods would be one sector to watch out, how they perform in this particular calendar year.
Shashank, before we allow you to escape, give us your top ideas for 2013. Where are you allocating disproportionate amount of money? Where are you confident of a 15 to 20% appreciation this year?
No, I think to begin with, the seasonal trade should be looked at. The seasonal trade normally is the Indian railway equipment companies, and this time around my sense is that there would be a serious rail budget coming our way. Clearly, given the fact that the capex will be far more realistic this time around, the projects will be conceived and will get the momentum in this year itself. I think after a long time one would tend to really understand that this time around the budget could be interesting enough. So I think I would bet on a number of these railway equipment companies. Some of them are quite interesting in terms of valuation.
You are not giving me names.
So that's one sector to really look at within the infrastructure.
You're not giving me. I want names. Come on, this is the first interaction for 2013. You got to oblige us with some names. What are you buying in railway equipment space?
No, I think there are certain names which we would have exposure to, like Texmaco Rail, infrastructure company. There could be also exposure to Escorts, which has a railway business with the large tractors business which it has. These could be certain names where we would have exposure, and we tend to be positive, expecting revival in the entire sector itself. So I think that is a seasonal sort of a trade, because prior to a budget normally people tend to bet on them. But my sense is this time around the budget could be realistic in terms of how the projects are outlaid, and there will be momentum in these projects, because I think the economy also needs capex, and this is one way of pushing the the capex cycle from the government's point of view. So this is one end which looks quite interesting right now.